Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. We've seen how a company's fundamental value is shaped by a few core value drivers: revenue growth, margins, capital investments, cost of capital. But valuation isn't that straightforward, right? The return that a company earns on its capital isn't the same as what the shareholders earn. That's why today I'm exploring what really moves stock prices and valuations. Not just what a company earns today, but what investors think it might earn tomorrow. And honestly, if there's one episode I'd urge corporate managers and board members to listen to, it's this one. Let me start with a paradox you've probably seen. A company reports strong results, double-digit revenue growth, expanding margins, solid cash flow. On paper, it's a very good year, but the share price falls. Another company might report weak results. Sales are down, margins are squeezed, but the share price jumps. How does this even make any sense? Well, it does make sense once you realize that the market isn't reacting to the numbers themselves. The market is reacting to the gap between those numbers and what was already expected. That's what's known as the expectations treadmill. It explains why a good company isn't automatically a good investment. If investors already believe that a company will grow fast, then those expectations are built into the share price today. So even if the company performs very well tomorrow, the share price might not move at all. Why, you might ask? Well, because the market already expected it. And here's how it works. Imagine a company that's expected to grow its net profit at 20% a year for the next, say, 5 years. Analysts, investors, everyone is aligned around that number, right? So the share price today reflects that assumption. It's as if the market has already pocketed those future gains. Now, suppose the company reports results and growth comes in at 20%, right? Solid results, exactly as expected. But the share price doesn't move at all. That's the expectations treadmill. You're running fast, the company is delivering, but you're not moving forward in share price terms. The idea is that for investors to actually make money, the company has to exceed those expectations. If earnings grow 30% instead of 20% and the market believes that's sustainable, then suddenly investors become more positive and raise their forecast assumptions. And that's when the share price starts to rise again. But the opposite is also true. If earnings grow only 12% instead of 20%, still very good growth, in my view, right? Still a great business, even creating value, but the share price can fall simply because the company delivered below what was already expected. And that's the logic of the expectations treadmill. You're not being judged against absolute performance. You're being judged against the bar of expectations, and that bar always moves. By the way, even though I've used net profit for this example, smart investors look beyond earnings, as we discussed in the previous episode. Now, let's compare private companies with public ones. If you've ever raised capital in a private business, you know that valuation is tied to expectations. Investors back you because they believe in your outlook, in your story, in your numbers, and they set a price that reflects a mix of confidence and uncertainty. So between one round and the next, the only anchor for valuation is the last funding price. If you've exceeded expectations between rounds, the next round can be done at a higher valuation. And if you fall short of expectations, your valuation could drop. For public companies, it's similar but different. Markets are open for trading every day. So the whole market adjusts expectations in real time. And that's because new information comes out every day, every minute. And investors basically race to price in those expectations before other people catch on. The information gets priced in almost immediately. So private companies deal with it periodically, but public companies deal with it continuously. So what does this mean for corporate leaders? It gives them a way to map their internal view against the market's view. If management believes revenue growth will be 10%, but investors expect 15%, then there's a clear mismatch. If management believes that the EBITDA margin will be 40%, but investors think it's going to be only 30%, then that's another mismatch. So expectations-based management highlights the importance of communication. Because markets don't just value what you deliver, they also digest how you frame the future. Guidance, tone, body language even. All of these signals feed into expectations, and in my view, managing expectations is as strategic as managing operations. Now, the obvious question is, how do managers of public companies figure out what expectations are? And the first step is internal. Companies need a clear, regular view of their own intrinsic value, usually through an investor-grade financial model with value drivers and scenarios. Because without that internal compass, how can board members and corporate managers really judge whether the market is ahead or behind? The second step is external. You look at sell-side estimates, sell-side analyst estimates, models, forecasts, research notes. They can give your company a map for the range of outcomes that the market expects. They're not perfect, but it's a baseline against which results are commonly judged. And then there are some more advanced tools, things like price implied expectations. Instead of asking what the company is really worth, the question becomes, what set of assumptions must investors be assuming to justify today's price? Basically, reverse engineering the share price to expose gaps between what the market expects and what management believes. The idea here is that companies that employ some of these tools can identify and manage expectations more effectively. For private companies, the principles are the same, even if the mechanics differ. Internally, management still needs a clear view of intrinsic value, and usually a forward-looking financial model isn't optional at all. It's just as important when negotiating with investors as it is when reporting to public markets. And externally, expectations are shaped by a smaller set of investors, usually a handful of family offices, private equity firms, or VCs, and their investment memos and deal benchmarks act as the analyst consensus estimates. The valuation isn't marked to market every day like in public markets, but the discipline is no different. The next rounding fund is simply the next checkpoint, and that's when management's actual performance and updated outlook are measured against investor expectations. But there are some challenges in our region. The first is that many companies treat the discipline of building an internal view of intrinsic value on an as-needed basis. And the problem with this is obvious. If we don't have updated and board-approved assumptions for future value drivers, the right ones, what are we managing expectations against? The second is that analyst coverage in the region is much thinner than in mature markets. In fact, many listed companies have no analyst coverage at all. So, without a reference point from the market itself, expectations can be a lot harder to identify. And the third is that disclosure practices are still evolving. Some companies provide the right guidance, the right narrative, excellent, but unfortunately others only stick to minimum requirements, and that makes it a lot harder for investors to form reliable expectations. The real risk here is that the share prices and valuations drop hard when reality doesn't match expectations. But it's also a real opportunity, because in markets where expectations are volatile, companies that manage them more proactively are in a much stronger position. So what's implied here? Well, any share price or valuation is a gift of information, if you ask me, because it reflects expectations of investors about the company's future performance. And meeting those expectations alone won't lift the price. Only changes in expectations do that. So the real question for any company is, what changes in future performance must be true for our valuation to change? Next episode, I'll argue that forming an internal view of intrinsic value makes all the difference between telling your own story and letting the market tell it for you. I'm Zein, and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.